This year, cryptocurrency has captivated the interest of the United States, and Olympic-level crooks have taken notice. According to William E. Quigley, a major investor and co-founder of the WAX blockchain, with the surge in popularity of crypto and blockchain technology, there will be an onslaught of unprecedented cryptocurrency scams. Before we continue, make sure to like, share, and subscribe. Share your thoughts in the comment below. Quigley stated during a panel discussion held by blockchain firm Lightnode Media last month that the high-tech nature of crypto will attract sophisticated crooks capable of pulling off Olympic-level hacks and schemes. Consider the recent Squid Game scam, in which investors claim that a new Squid cryptocurrency token and associated immersive online game were nothing more than a con. According to investors, the creators vanished when the currency's value soared, and they seemed to pay out with more than $3 million prior to investing in crypto. Crypto investments should make up less than 5% of your whole portfolio, according to experts. Cryptocurrency prices fluctuate drastically from day to day, and experts advise not investing more than you'd be willing to lose if the market collapsed. Other financial responsibilities, including preparing for emergencies, paying off high-interest debt, and saving for retirement via more traditional investment tactics, should never be compromised by crypto investments. Crypto investors, whether they like it or not, are exposing themselves to a new and evolving danger of fraud and scams. If you've added cryptocurrency to your financial portfolio or are considering doing so in the future, here are some frequent frauds and red flags to be aware of. What are some of the most popular cryptocurrency scams? According to the Federal Trade Commission, about 7,000 consumers lost upwards of $80 million in crypto frauds between October 2020 and March 2021. FTC. That's a significant increase from the 570 Bitcoin investment scams and $7.5 million in losses experienced in the same months the previous year. With the development of Bitcoin frauds, here are several patterns to keep an eye out for. Requiring crypto-only transactions. It's most likely a fraud if a seemingly trustworthy person or retail establishment declares they don't accept any currency other than Bitcoin. Because Bitcoin and other altcoins are such a new asset class, analysts believe that reputable institutions will not take crypto without also accepting US dollars via wire transfers, checks, credit and debit card payments, and cash. Anyone requesting payment in Bitcoin may be attempting to hoard it and profit from its increasing value. Blockchain, unlike banks, lacks standard Know Your Customer (KYC) processes. This means that consumers can access their wallets without needing to show legitimate identification, a social security number, or their address and contact information. Even though blockchain is accessible to the public and provides permanent, open access records, people can transact on it anonymously, making it easier to defraud you, take your money, and flee. Fake or anonymous identities. According to Jonathan Padilla, former PayPal head of blockchain strategy and CEOs, and co-founder of Snickerdoodle Labs, a California-based blockchain data security company that's looking to use blockchain to give consumers ownership of their cookies and browsing data, the lack of KYC protocols on blockchain is a major question mark for its widespread use. There are really no safeguards in place with a decentralized platform to indicate who is a good actor and who is a terrible actor, Padilla argues. It's just a case of buyer beware. On a more positive note, blockchain has the potential to deliver a new level of transparency. All transactions on blockchain are public records because data can't be changed or withdrawn. Investigators from the U.S. Justice Department were able to follow the transactions on blockchain and recover the ransom money when Colonial Pipeline paid unnamed hackers 63.7 Bitcoin, worth nearly $2.3 million in June. The hackers moved the Bitcoin around using a hosted wallet, which meant law enforcement caught them in roughly 5 days, Padilla explains. With the tools coders are developing, you can now utilize sophisticated software to do an on-chain analysis and follow where these things travel. However, it will only be a matter of time before law enforcement agencies at all levels of government get enough familiarity with new techniques to efficiently probe smaller-scale blockchain scams. There's still a chance that bad actors will utilize crypto tokens, NFTs, and other digital blockchain assets to launder money on both small and large scales. That's a legitimate fear, Padilla says. For example, you could acquire money from Colombia, use it to buy an NFT, and then wash it in an NFT. Money laundering on a large scale isn't common, according to Padilla, but the tools and compliance framework need to catch up quickly. The technology is just getting there, Padilla adds, to be able to track where that money comes from and where it goes. However, it hasn't been there for the last half year, he says, referring to the meteoric rise in popularity of crypto and NFT. Experts recommend sticking with beginner-friendly crypto exchanges like Coinbase and Gemini to avoid the hazards associated with smaller, specialist exchanges. Beginner cryptocurrency investors should stick to the two most popular cryptocurrencies, Bitcoin and Ethereum, which have a longer track record of gaining in value than other new altcoins, games, and digital collectibles. Sophisticated coders now have the potential to construct new games and entire imagined worlds on blockchain, as we saw with this Squid Game fraud, and to accomplish it before the next Netflix sensation takes off. Getting eager blockchain beginners to buy a type of newly produced coin or token for a game is a simple way to defraud them. If enough people push up the price due to supply and demand, the original con artists can sell all their assets and vanish in a move known as a rug pull. On the blockchain, unlike bank accounts for federally regulated currency, there is no fraud protection or FDIC insurance. The only method to get your money back when it's stolen on blockchain is for the recipient to pay you directly. That's exceedingly unlikely on a decentralized exchange. While big crypto exchanges have greater fraud security procedures than lesser-known exchanges, investors are still at risk of losing their funds. Schemes for investing in cryptocurrencies. New types of cryptocurrencies are continually being created, and when new currencies are released onto the blockchain, it's referred to as an initial coin offering, ICO. However, ICO can also be used to perpetrate fraud. A corporation or an individual may claim to have a once-in-a-lifetime opportunity to invest in a new kind of cryptocurrency with guaranteed 1,000% returns. They may then try to persuade you to deposit many fresh coins into a digital wallet that has been hacked, or to pump and dump by buying the coin and selling when the price skyrockets. Scams in the romance industry. Crypto frauds abound on dating apps. According to the Federal Trade Commission, around 20% of the money lost in romance scams from October 2020 to March 2021 was transferred in Bitcoin. Long-distance or digital connections are used in scams like this, in which one party presses and persuades the other to buy or provide money for a new cryptocurrency that is simply a technique to defraud people. Scams including phishing. This type of scam is as ancient as the internet, but there are some additional consequences with cryptocurrency. Bad actors send emails seeking to lure recipients into clicking links and inputting personal information, including crypto wallet key information, just as they would in a regular phishing assault. You only get one private key to your blockchain wallets, unlike most passwords and usernames. This is part of blockchain's decentralized nature, which ensures that no single entity has authority over your data, but it can be inconvenient if you need to alter your key. How can cryptocurrency investors protect their investments? Even the most knowledgeable and passionate cryptocurrency professionals recognize that the world of crypto is now rife with new and developing threats. Some people have been victims of frauds, such as blockchain investor and entrepreneur Ian Bellina, who claims he lost $2.5 million after his private wallet key information was stolen from his Evernote account by a hacker. Even successful investors face the risk of loss and fraud when dealing with such a new, volatile asset class, as Bellina's case illustrates. Most passive investors are advised to maintain crypto holdings to less than 5% of their portfolios and to never invest in crypto at the expense of preparing for emergencies or paying off high-interest debt, according to financial experts. If you're ready to start investing in cryptocurrency, follow these guidelines to keep your funds safe. Red flags in cryptocurrency. For starters, keep an eye out for the following red indicators, which are identical to those seen in classic money wiring scams and credit card fraud. In emails, on social media posts, and during any conversation, there are typographical errors and blatant misspellings. It claims to be able to multiply your money. Contractual commitments that bind you to retaining cryptocurrency and prevent you from selling it. Influencers who aren't real or who claim to be celebrities. Blackmail or extortion are examples of psychological manipulation. Cryptocurrency scams on large social media platforms. Free money promises. Uncertainty about where your money is being spent. When should you use a crypto wallet? You must safeguard your digital wallets from hackers in the same way that you protect your physical wallet. Put big sums of money in a safe or FDIC insured savings account to practice good digital security habits, like how you'd handle real cash. Small-scale investors with a few $100s in crypto should retain it on a mainstream exchange like Coinbase, according to experts. However, if you've amassed thousands of dollars in cryptocurrency, it's generally a good idea to include a wallet for extra security. Crypto wallets are divided into two categories. They're also known as hot wallets and cold storage, and others call them hosted and unhosted storage. Hot wallets are stored or hosted over the internet. They're safe, but they're more vulnerable to hacking than cold storage, which involves storing cryptocurrency on a piece of hardware. Consider cold storage to be like a USB drive-size safe. It's safer, but if you forget your password or misplace your device, you could lose access to your funds permanently. Like cash in a bank, cryptocurrency held in hot wallets is not FDIC insured. As a result, you'll want to make sure that whichever platform or wallet you use to store your crypto has strong security features, such as authentication using 2 factors, having its own cold storage for a portion of its holdings. In the event of theft or hacking, private insurance policies are available, separate from FDIC insurance. Keep a close eye on your wallet keys. According to Mac Gardner, a Florida-based certified financial planner and creator of Finlit Tech, you only get one unique key to access your wallet. If you lose or have your key stolen, you may lose all your crypto. You'll need a lot of control over who has access to your wallet key. You can't forget your username and password if you don't write it down, Gardner explains. Each code has a certain process and a set quantity of characters. Because of the virtual space, it's incredibly individualized. If it wasn't, anyone could walk in and seize your belongings, right? Fraud should be reported. You should use these links to report fraud and other suspicious activities concerning cryptocurrencies to the following bureaus: the Federal Trade Commission, FTC. The Commodity Futures Trading Commission, CFTC, has a complaint form at CFTC. The Securities and Exchange Commission, SEC, of the United States. You can also contact the FBI if the scam involves extortion or blackmail. Also, once you think or have evidence that criminal actors are at work, report the scam to the crypto exchange you used to make the Bitcoin transaction. Interested to know more about crypto? Don't forget to like and share the video. Please subscribe for more great videos.